everyone, let's begin with our capital budgeting lesson. Okay, FM. We are going to do the theory part of capital budgeting. All the problems have already been solved. The practical part is already taken care of. You can refer the video. Now, capital budgeting. Basically, we all know capital budgeting means we are talking about capital assets. Okay, the budgets the amount which are going to get blocked if there will be an investment in the capital asset. Okay, capital assets are those assets which are to be invested for the long term period. Okay, there is a huge amount of investment which are to be done in the capital assets, therefore they have to be as per the budgets. We have to analyze whether this particular asset is going to give me that much of cash inflow or no. That much of inflows, amount of work which I'm going to expect from 1 year to another year. Okay, the number of years of cash flow is going to get generated or no from that particular asset. The budget is prepared, the returns are ascertained, and based on that the decision is taken. Whether investment should be done in this particular capital asset or it should be rejected, approval or rejection. So there are various methods also. So basically is to evaluate the potential major projects or investments. Okay, construction of a new plant or big investment. Okay, you are going to invest your amount in, say, some kind of building, plant and machinery. So those type of investments or those type of capital assets require a lot of evaluation. Okay, so the process of evaluating the investments and huge expenses in order to obtain the best returns on investment. So these are all the decisions which you need to take, whether you need to buy a new asset, you need to replace the current asset, or you need to accept the project or reject the project. All these decisions are taken by the top level management. Therefore, it is known as a strategic planning also. Strategic planning. Long-term plannings are strategic planning because obviously it is taken by the top level management. Okay, so according to Charles Horngreen, capital budgeting is a long-term planning for making and financing proposed capital outlays. Capital outlays means capital investments. So importance, why do we need capital budgeting? Why do we need to prepare a budget and understand its evaluation? Importance. Why? Because it is a long-term implication. Once you take this particular decision, you cannot go back from it. Okay, it is going to stay with you. It is going to give you that returns or amount of inflow which you have already calculated today. Then involvement of large amount of funds. It is a good huge amount of funds which is going to be utilized of that organization for this particular investments. Okay, for this particular project. Irreversible decision, obviously. Okay, risk and uncertainty. Of course, there is a great number of uncertainties which can happen, probable unseen events which can occur. Okay, in present, future events, okay, which can occur. So investments also we calculate. That is why we have studied time value of money, that in the future I am going to get that much of return. I am going to get return of 20,000 in future. But today what is that value? Present value of that future 20,000 rupees is how much? We have to ascertain the risk as well. And it is of course difficult to make. Okay, it has got a lot of complications. Management has to do the overall assessment of the future events of the organization, their goals, their achievements. Okay, what will be the amount of inflow or how much is going to be the work which can be done by that particular asset. So it is obviously difficult to make. So capital budgeting process, if you see in this particular diagram, it's the entire summary of the chapter. Basically, first is to identify your investment opportunities, whether you have those opportunities. Say there is project A, B and C. Assembling the investment proposal. Assembling, how will you do the assembling? First you will do the ascertainment of their returns. Okay, how much will be their inflows? when will be the break even point, how much will be the payback period. Payback period, break even point, one and the same thing. You will assemble these proposals, then you will place it whether first it should be A, then B, and then C. Okay, then decision making, then capital budget, and you will start appropriating. If your investment is say 100 crores and you are investing in 2-3 projects A, B, C all together, so how much of amount is to be invested in each, but in each capital asset. Then you will start implementation and then performance review of each project. All right. Now, how do I do this? Like when I'm doing assessment or evaluation, how do I do it? There are two techniques. One is a traditional technique, and now we have all our modern techniques. Traditional techniques is a break even. When am I going to get the break even, payback period? In how many years will I be able to recover my initial amount of investment? So today if I invested 50,000 rupees, in how many years I'm at least going to get the return of 50,000, right? And then we have average rate of return. Average rate of return means what? How much amount of profit upon your investments. This also we have done in the form of practical problems. So you all can of course analyze it and understand it. Average rate of return, if I will say, so I will say about average profit say for 5 years upon average investments. That is why it is known as ARR. And then the net present value method, which we had calculated. Okay, net present value method is now, why do we do this? These are all modern techniques. In net present value, we take the time value of money, which is very important. Present value of your future cash flows. Okay. Internal rate of return method, profitability index method, all these are your modern or discounted cash flow techniques. Okay. So each method now they have given it in the form of theory. So first the traditional methods are also known as non-discounted cash flow. Why non-discounted? Because they do not take into consideration the time value of money here. Okay, that is why they are known as non-discounted cash flow techniques. Now first one is your payback period method and the next one is your average rate of return. Payback period is nothing but the break even point. So this technique estimates the time required by the project to recover through the cash inflows the firm's initial outlay, their initial investment. Okay, beginning with the project with the shortest payout period, different projects are then arranged. So first each project's payback period is ascertained, then the one having the shortest payback period is put first. Okay, is put first. So while estimating the cash flow for each investment proposal, we have to ascertain and understand the following considerations we have to take into mind. First, cash inflows which we are going to get should be estimated or obviously on incremental basis, so that only the difference between the cash inflow of the firm with and without proposed investment project is considered. Incremental, no cash inflow. Yes, we do, that is known as cumulative. So you can even try to find out cash inflow for each year. Then cash inflow should be on after tax basis. Cash flow after tax. We used to do CFAT. Since non-cash expenses like depreciation do not involve any cash outlay, we try to adjust depreciation. So we always adjust a CFAT with the rate of depreciation. And payback period, it is very simple. If I am trying, because it is not considering any time value. So if I tell you payback period, my initial investment is say 25,000. Okay, and cash inflow, annual cash inflow is 5,000 for 10 years. Okay, cash inflow 5,000 for 10 years. Then payback period will be how much? Obviously 25,000 divided by 5,000. In 5 years you will be able to recover your 25,000. Break even. You will be able to recover your initial investment. See, there is one example. Since I have already done this, but quickly, it is very simple, we'll go through it. 25,000 is your initial outflow, cash outflow. Okay, and inflow they have given to me as 6,000, 9,000, 7, 6 and 4. Number of years, 5 years. Okay, so the payback period, how we have calculated with the help of cumulative cash flow. Year 1, 6,000. In year 2, obviously you will add 9 to this 6, 15,000. Then 7 plus 15, 22,000. 6 plus 22, 28,000. And then 4,000 to 28,000, 32,000. Okay, so in 3 years, if you see here, in your 3rd year, in the 4th year, you are already crossing your outlay. Okay, outflow you are already crossing in the 4th year. So basically, in your 3rd year, you have already recovered 22,000. So from 25, you have recovered 22,000 in your 3rd year itself. So only balance 3,000 is left for you to recover. Right? Why do we do this cumulative? So that we come to know our break even. Easy, no? Quickly we can analyze it. Now this 3,000 obviously I will recover in the 4th year. But in the 4th year, my inflow is 6,000. So basically it is 6,000 for 1 year. So for 3,000 it will be how many months? So you can say 6,000 into this is 6,000 is for 12 months. So for 3,000 it will be how much? You can do 1 year or you can do 12 months. One and the same thing. You cross multiply. So 3,000 into 12 divide by 6,000. Okay, so you will get an answer which is okay 6 months. 6 months means 0.5 year. So it will be 3 years plus 0.5 years. So 3.5 years or 3 years and 6 months. Same thing if you would have done this one. So this is how you would calculate. 3,000 is left for you to recover. In the 4th year you are going to have cash inflow for 6,000. So 3,000 it will be how much? So you can make this one. So they have done the same thing. 3,000 divided by 6,000, 3.5 years. Don't get confused. Okay, it is the same thing which I have solved in all the sums. Nothing new. Then another sum they are giving that the project is expected to generate 25 million per year. Net cash flows are for 7 years and the outlay, the investment outflow is 100 million. So if I want to calculate the project payback period for 7 years, same 25 millions only it is going to keep on generating. So my annual cash flow, I will just divide that with my initial investments, divide by annual cash flow, it is going to be 4 years. Then similar example they have given to me, example number 3, same thing, you all can solve this also. Same thing like how I just did the previous sum. So decision rule of the payback period is very, very important. Okay, decision rule. So when will I accept my project? Okay, I will accept my project if the payback period is obviously equal to or at least less than what was decided by the management. So management will have something in their mind, no, that we need to touch our break even in 3 years. We need to touch our break even at least in 5 years. So if I am able to have my payback period in that time, within that time, equal to or less than that time, I will accept the project. Otherwise, I will reject that project and try to see another project with a shorter payback period. Clear? First one, payback period. Okay. Now the next one is your average rate of return, or it is also known as accounting rate of return method. Accounting rate of return method. Okay, so here what do I do is I try to find out my net earnings after depreciation. Okay, but I need to find the number, average. Divide by number of years the project is going to last. Divide that by original investment. Okay, average rate of return on the investment. Even if you don't do these formulas, Okay, even average return on average investment will be net earnings after depreciation upon number of years the project will last. Same thing, divide by your original investment. What I have done is average return, okay, upon average investment. That is what you all have to do. The same, even if you all don't do this formula, nothing, it is not important. Okay, decision rule is very, very important. In each and every method, your decision rule is very important. Okay, so when are you going to accept the project or reject the project if you are doing ARR method? So accept the proposal if your average rate of return is more, it is greater, okay, greater than the minimum rate of return or the cutoff rate, and the reject the project if your average rate of return is less than the cutoff rate. Okay, so you analyze the different projects, try to find out your average rate of return. If it is giving you more returns than which is existing as per the benchmark rates in the market which they give, okay, cutoff rate, then of course you will accept the project. Then you have discounted cash flow method. Why discounted cash flow methods? They are also known as modern techniques. Why? They are now considering the time value of money in this particular sums. Okay, so net present value means nothing but in the net present value, it is the difference between the sum of the total present value of all the future cash flows and outflows. So until now what I was doing, cash inflow and I was doing cash outflow. But now they are saying that first understand the future, the present value of both. Present value of your future cash flows, inflows. Okay, and present value of your cash outflow. Both have to be taken into consideration, okay, before you decide into anything. Future cash inflows, present value. In future, I am going to get 20,000 rupees after 1 year. But present value of this 20,000 today, what is the amount of 20,000 today? I need to ascertain that. That is important. Okay, so value today is important. So if your net present value is greater than your 0, okay, then you will accept the project. Net present value less than 0, you will reject the project. And if it is the same, then yes, you can. It is indifferent whether you accept or reject. It depends on the management. Then internal rate of return. Basically, what is internal rate of return? Which equates the present value of cash inflow and present value of the cash outflow. Okay, the rate at which present value of the investment becomes 0. Okay, net present value, whenever net present value is equal to 0, at that rate, it is known as internal rate of return. Okay, so internal rate of return, if it is more than your cutoff rate, same thing. If it is more than the cutoff rate, accept it, means you are getting more return which is there in the market. Okay, more return than your cost of capital. If you are getting more return, then you will accept the project. Vice versa, you will reject the project, and if it is same, it is indifferent. Then we have profitability index. Don't do this particular formula. Profitability index, do it from my sums. Present value of your future cash inflows upon your initial cash investment. Same thing. Okay. Amount of cash benefits you are going to get. Present value of that. Okay. Amount of future cash flows which you are going to get. You have to get that to the present value. Divide by your initial investment. Okay. So if your profitability index is greater than 1 is the benchmark. Okay, benchmark. you will accept the project. If it is the same, you will reject. If it is less, obviously you will, if it is the same, it is indifferent. If it is less, then you will reject the project. This is the last part of your capital budgeting. It is important. Capital rationing. Okay, from your theory point of view, this is important. Now, what do you mean by capital rationing? Rationing means setting up of a limit. Setting up a limit or a ceiling. Means it is a point wherein you cannot go beyond this. Okay, so say suppose you are the finance manager, okay, of a company, okay, or you can say you are the chief executive officer of a company, and you have been given a task of ascertaining where the investments can be made and what should we invest in to have our profit maximization, etc. So you are supposed to analyze and see whether that project can be undertaken, and you have already told him that the amount of investment should not exceed 100 crores. Okay, so the finance manager will try to find out those projects in which the initial investment is up to 100 crores. So he might find any one project or different projects, say 10 different projects, 10 crore investment in each. Okay, so when we try to set up such ceilings or such limits, okay, and when we try to ascertain the returns, what happens is there is also a opportunity loss here. Opportunity loss. Why? Because see, what happens is, I keep on I do trading, okay. I keep on investing money in my stocks, and I do it along with my friend, right? Now what happens here between both of us is that I have a certain budget, okay, and I keep that budget as my ceiling. So say I invested the other day only, I had invested 50,000, he invested 5 lakhs. Okay, both of us got the return. My ceiling was only 50,000 max. I said I can invest only till this, and the return which I got on that day was 20%. Obviously, even he got the same return. If I would have invested more, at least same to as what he had invested, I would not have an opportunity loss, because there was a risk. So of course I was unsure whether I should go ahead with this particular amount or no. So I set a limit to myself. So capital rationing also is the same thing. When we set up a limit, so when there is an additional advantage of earning from that project, then that gets, you can't really go ahead and invest it, and like this lot of opportunities are lost, right? So this is the same thing, like it happened with me some days back only. So it's capital rationing is the maximum amount which is being set up to be invested for a given period of time. You cannot go beyond that. Since you cannot go beyond that, so even if that project is going to give you really good returns, there will be no returns to you. It will be only up till that limit, and obviously, but you need to have a ceiling, that is known as a capital rationing. Okay, so we will just read this quickly. One important aspect of control device, it is a control device. Why? Because we are trying to put a ceiling, maximum limit, is to match the demand schedule for the capital for the company. What is the demand? And the supply of capital from different sources. So demand comes from capital of all the departments, and it is the level control could be exercised to keep the demand at bar minimum required for an objective, minimum required investments, okay, so that capital investment decision is taken. Supply of capital, on the other hand, is the scarce commodity, and company has to incur expenditure for availing it. Can I avail, like can I have the capital free of cost? People will invest in my company free of cost? Of course not. There will be a return which is expected for the people who invest. Okay. So the finance manager has to exercise economy in capital expenditure, so there is an optimum benefit could be obtained with the use of scarce capital resources. This establishes the need for capital rationing to impose constraints on capital expenditure under the prevailing market conditions and places self-imposed constraints. So this 50,000 which I invested, it was my self-imposed constraint. It was a control device to check that whatever the funds I have invested, say I had borrowed this from my husband. Okay. Companies borrow it from the outsiders. So they are answerable. They have to provide them that return. Therefore, it is always important that to whatever is the demand of your capital, okay, you prepare a budget, understand whether there will be a supply given to you for that capital. Okay, and then therefore there is a limit which is put up. So the firm may put a limit to the maximum amount that can be invested during a given period of time, such a year. Okay, so this is known as resorting to capital rationing. Constraints are being put, okay, and select a combination of investment projects that will be within that specified limits for that given period of time. Obviously with the greatest profitability. If you see, my profitability here is really high. 50,000 and 20% I gained in what, like 2-3 days. Okay, so risk is high, but the profitability is also high. If I would have invested more, so you know, when you have 20% return on 50,000, you will never be able to see that. But if you have invested a big principal amount, your return, when you get that return will be like, oh yes, this is the amount of profit I have made. Now 5,000 and 2,000 profit, nothing. 1,000, 2,000 profit. Okay. So capital rationing may be affected through this budget ceiling. A firm, so when you try to resort to capital rationing, you try to have those type of capital rationing restrictions. Obviously then your amount of earnings will be also restricted. So you will not be able to plow back those returns back in your organization. Okay. So this is what is it. You can just go through it and read it. That is it with your capital budgeting chapter. If you all have any questions, if you all have any doubts, you all can ask me. And regarding the methods of capital budgeting, yes, please go through all the sums which we have solved. Okay, all the sums we have solved: IRR, ARR, payback period method, profitability index. I have not left any sums. Okay, even the big problems have solved. We have also solved it in the form of small MCQ type of question. So please refer that. Okay. Thank you everyone.